Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. At least the last time I checked, I was. Today's Friday, April 29th. The market's going to open up in about an hour and 26 minutes. And as you can see here, the Dow Jones is down 106. The NASDAQ is down almost 200 points after having a really strong day yesterday. And as usual, the S&P is meeting us somewhere in between. Now, again, yesterday, we had the opposite effect. We had the Dow and the S&P up about 200 points at the open, and I was pointing out how their values are so different, but they're both up 200 points. But today, we're seeing almost the opposite of that. We're seeing the NASDAQ down 200 points, the Dow down about 160 points. But again, this is at 13,000. This is at 33,000. Why are we having such volatility right now? Earnings. This week is actually the biggest week for the largest cap tech stocks. Just last night, we had Apple, which is down about 2% pre-opening bell, and they actually beat expectations. So this will be a very interesting day for Apple. We have Amazon, which is down 10%. This stock has a lot of market cap, and it also talks a lot about consumer demand right now. And lastly, we've got Twitter, which is up a little bit. Twitter's been on a good run the last several months, since about end of February. So, and we all know why, because Elon Musk is buying the company. Now, today, before we get too far ahead, let me just show you what's on the docket. You got AbbVie, $3.15 per share. AstraZeneca, big company. Bloomin' Brands, big restaurant brand. Bristol Myers, CBOE, that's a big one. Charter, Chevron, Colgate-Palmolive, one of the best consumer staple stocks right now. ExxonMobil, a lot of energy stocks. Honeywell, it's a industrial stock. Newell brand. I mean, look at this. You've got a lot of stuff. I mean, these are big companies. AbbVie's a big company. Colgate's a big company. Charter's a big company. Exxon. So you've got a lot of volatility. And it's going to be very interesting to see how this week shakes out. I believe by the end of this week, we're going to have numbers for roughly, don't quote me, but roughly 210, maybe 220. So it'll give us a very good understanding of where the S&P is. But we got to be patient and wait a little bit. Now, yesterday we had the GDP report. The GDP was awful. The number was just awful. But it showed that people are actually spending money, that the spending is actually resilient, really resilient. But again, the number was not so good on the annual rate, but a lot of it was taken out because of the bottlenecks we're having in the consumer market right now. So again, today we have the personal income report, and that's going to give us a better indication of how much people are spending and saving right now, which is really important because the word recession has gone. So I want to see what consumer expenditures on a month-over-month basis. If consumer expenditures are solid, well, that means people are not being fearful of the current slowdown in the economy, and that means there's less chance of a recession. The bond market has been moving completely choppy, which is really good and telling us that the stock market's getting a little bit of a reprieve, because bonds moving sideways is telling us that the bond market is not assimilating the Fed lowering or increasing rates, which also may happen because the GDP yesterday was so damn bad. So the Fed may say, you know what, because the GDP is so slow, we may just kind of slow things down a little bit, or maybe not raise interest rates 0.75 of a basis point. But the bottom line is the bond market has not been going down for 2 weeks right now. Now, I'm hoping we're going to get an upside tick from here, maybe go to the 130 level, 135, so I could sell the bond market. I really want to sell the bond market because ultimately, look, bonds are going to go down, interest rates are going to go higher, but I'm hoping we can get a little bit of a reprieve, which will release some pressure from the stock market. Market internals are really bullish. Put the call ratio still at 116. We're still grossly inflated. We're over that one level right here. Let me just draw that level. Anything above here is telling us that the market is grossly buying too many puts compared to calls. We went all the way to 130 earlier in the week or last week. That's the highest level we've seen since the end of 2018. So the fact is the stock market is oversold right now, and it needs to go up a little bit, not down. that is also confirmed by volatility, which actually has been going down. It hasn't been going up. It started this week on a high note, really rallied, but now it looks like it's cooling off. And if today the market rallies, then we should see a little more downside from volatility. We have puts right now in the volatility index. As far as sectors, I wanted to show you something interesting. And this is actually really important. Remember, markets get fragmented on the way up and they get defragmented on the way down. Now, I want to show you something that I haven't seen in a long time. I'm finally seeing it in the market now. Finally, which means markets could be getting ready for a big move. Look at technology and consumer discretionary. They're next to each other. Look at basic materials and industrial. They're next to each other. Look at consumer staples and utilities and energy. They're all next to each other. Markets are not fragmented anymore. Now, typically, I want to show you this. This is actually really, really interesting. Let me show you this. And by the way, 60% of stocks in the Dow are trading above the 200-day moving average. We're not in a bear market. But I wanted to show you this. This is the NASDAQ 100, and this is momentum levels. Now, I wanted to show you these momentum levels over the last 20 years. I think I can only go back to 2007, so it's about 16 years. But notice where we are right now in the big scheme of things. We're real close. We're at like 28%. We're very close to the bottom. This is COVID. This is 2018. That's the last time volatility went to where it is. Remember I showed you this, the put to call ratio? I showed you that the last time volatility went this high was right here. Wait, nope. It was higher. Here, this is really interesting. Look at this. So 130, look at that. You see that? December, look at the right up here when I point my mouse. See, that's December 2018, right? Now, look at momentum levels. Same thing, December 2018. Now, this is COVID. We all know what happened in March of 2020, or do I need to show you a chart? Let's see here. Right here. So every time this spike, the market, these things tend to move higher, and we're really low. So while everybody's looking for the market to crash, it kind of sort of already did. I mean, it's not a crash, but we've been going down since December. We've been going down for the last 4 months, momentum levels, and we're finally breaking down to the bottom. So this is a very positive sign. We're breaking down to the momentum levels, almost at the bottom. The bond market is moving sideways. Put to call ratio is declining, and it's still above the threshold level. And volatility via the VIX is also declining. So while we're in the middle of earnings season, I am starting to see volatility move down, and I'm starting to see a bullish market. Also, frankly speaking, if you look at the QQQ right now, and we will just do this here, it's also at the base, and RSI is way overdone. So everything is pointing to higher prices. There's a really good chance we're going to start hitting the 200-day moving average in a rally over the next couple of weeks. So hold on to your seatbelts, because things are going to get wild. Now, before I conclude, I want to show you we took some trades this week off the table. Even though the market's been down, we got into Mosaic. Let's see. We got into Mosaic on 425, right here, right there. And we got out of it the 27th, right there. Nice juicy 20% gain, 2 days. We got into SYF to the short side. Yes, to the short side, right at 420, right here. And we got out of it when? 422, right here. Nice juicy 22% gain. And another short we took, TJX. We got into it on 421, right here. When do we get out of it? We got out of it right here, 422. So, 422 the next day, right here. For just 1 day, 40%. So we've been doing pretty good. We've been doing pretty good. 3 trades this week, and we're still holding on. Now, again, pay attention. We've got the personal income. And again, GDP's down, but personal spending is up. It's not that bad. And remember, if people are spending more and more, there's less and less chance of a recession. Look at that personal consumption expenditure. Prior consensus, 2.5. Not bad at all. So again, We've got sectors that are not out of rotation right now. We've got S&P starting to show broad market exposure. Nucor, Dollar Tree, CF Industries. These are not energy stocks. These are broader stocks. And I'm seeing Bristol Myers, Host Hotels. I'm starting to see stocks that are less and less related to COVID and more related to going out and economy moving higher, like Marriott, like Kraft. Remember, Kraft owns a ton of different food supplies. So there's a lot of stocks that are gearing up right now, and I'm starting to smell a rally on the way. So, folks, volatility is nuts. We've seen some huge moves in the markets this week. Chuck Hughes, multi-million-dollar trading champion, he's been secretly working on a project that could be the cure for the current market blues. He says it's the boldest prediction of his entire career. Chuck and I were going live at 1 p.m. Eastern time today for his big reveal. While the rest of the world is in chaos, scratching their heads, wondering if or when recession will come, he's gearing up for takeoff, and so am I, frankly speaking. And by following the facts, not emotions, he believes we could be set up for a windfall of a decade. Click the link below to access today's live event. Hope to see you there. Bye, guys. Follow the link below. This is posted in the Wealth Press YouTube channel if you can't find the link. Next week on Monday, weekly outlook, biggest threats, biggest opportunities. What a crazy week, right? I'll see you later. Send me some love letters. Support@marketgeeks.com. I want to hear from you. Haven't heard from you in a while. Bye, guys. Have a great weekend.